will talk about, economic optimism and tariffs as we go through this conversation. But if anything, if the economy is stimulated any further than it is right now, right, we're going to have higher interest rates because inflation will be higher. And, the Fed doesn't control interest rates either. The bond market controls interest rates. So a lot of people kind of don't fully appreciate that. They're like,
Yeah.
oh, the Fed controls overnight interest rates that banks use, right? But the lenders work off the 10-year treasury, and the yield and the relationship between the 10-year treasury and their spread. So let's say the treasury right now, the 10-year treasury is 4.6%. Add about 2.5% to 3% onto that, and you're going to get your 30-year fixed, right? That's how it works. And so if the bond market right now is pretty bearish, and so yields have risen in the last week or two because the bond market thinks there's going to be increased economic activity, increased economic optimism. And so inflation is going to take off again. And so if inflation takes off again, guess what happens? The price of bonds is going to go down. And so the yields are going to go higher because bonds are going to move into the market, right? The capital that's in bonds are going to move over to the market. And so it will, the cost or the yield on the 10-year bond is going to increase. So I don't think the president is going to control interest rates in any way, shape, or form other than their actions, right? Yeah. So the idea that someone would say in a campaign, I want to bring mortgage rates down. A great way to bring mortgage rates down is to drive the economy into a recession. That's a great way because more and more people will move out of equities into the bond market, bringing yields down, which will give you lower interest rates, right? Yeah. And so if the market and if the economy is being juiced, I think it's fair to say, and the bond market is telling you this week, right? I'm in some positions that are counter-cyclical to the market, right? I kind of have a little hedge strategy going on in my world. And so the bond market right now is saying, we're nervous about tariffs. We're nervous about the economy getting juiced. And so we're nervous about inflation. And so get ready for Mr. Trump to be railing on Fed Chief Powell every day. You're going to hear that every day for the next, 2 years until his term is up in 2026. And so then there will be a new Fed chief. What that, and how that impacts, I don't know. But it's really the bond market is the most powerful thing on earth. It's not, we all think it might be Xi Jinping or Donald Trump. The bond market is the most powerful force on earth. And so I don't see lower interest rates being a factor, Clark, really anytime soon. I think if anything, interest rates are going to hover a little bit higher, and they might even trend further in the next. So I don't think we can expect to see significantly lower rates really anytime soon. That would be my take.
So yeah, I'm glad that you bring that up because there's a big thought of perception is reality, right? So let's talk about the optimism. Okay. So if there is more optimism in the market, just in general, right? And it could be fictitious. Do you think that kind of perceived idea of more confidence in the market, that's going to increase activity, increase trading, even if the interest rates stay similar, even if they don't, maybe they tick up or tick down, but it's not of any huge relevance? Is this, because I've seen it, you saw Bitcoin, right? Trump went in and bought a cheeseburger or something in New York with Bitcoin, and Bitcoin like shot to the roof, right?
Yeah.
All he did was buy a freaking burger with Bitcoin, right? And it exploded, right? So that confidence that they had in it went up in Bitcoin. What do you think in terms of just the perception of confidence and how that could impact things in our climate, whether it's in real estate or just in the economy in general?